Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
Market call. It's Thursday, September 25th. That's Liz Thomas of SoFi. You know her, you love her. We're going to get through her note today. I don't know if there was enough puns in the note there, Liz, but
Not enough puns. We took a very serious approach to research this week.
You always do, but I think the unseriousness is when Guy and I are pressing you on the puns, because you and Mario obviously do amazing work. And I really like what you guys did this week. We're going to get to it. You're talking about rate cutting, rate hiking cycles, how the markets have reacted over the last 30 years. We're going back 31 years. I know where you were 31 years ago. You had pigtails. You probably were wearing socks just below your knees. A lot of stuff. Is that accurate? Maybe.
I don't know how old you were for the slouch sock era, where it was like IOU sweatshirts, and then matching slouch socks.
Yeah.
But that's probably roughly where I was.
Well, here's one thing.
Years ago.
Because we might talk about the consumer today, and in the consumer, our consumer trends, and I was thinking about this. I keep seeing the kids on the street wearing rugby shirts. You remember a rugby shirt, it could have been a solid color with like a white sort of collar, sort of thing. That was a big J. Crew thing. That was a big, probably Abercrombie thing. So the kids are wearing them again today.
You know what I heard once, and it has stuck with me ever since, is a fashion rule that you can never repeat a trend, because if you're repeating it for the second time in your life, it means you're too old to wear it.
I like that.
And I think that's a good rule. I think it's a rule everybody should live by. So if you've already done this, like I've done the IOU sweatshirts and slouch socks thing, if that comes back, I'm not allowed.
Google. Jacob, can we get some eyes on IOU sweatshirts? And then also, while you're doing that, I don't know if this was a dream or not, and we're going to get to the markets because there are a lot going on in the markets today. I can't remember if I was talking about the rugby thing, and my wife, I think this was a dream. Sarah said to me, yeah, I tried to get one of those Benetton rugby shirts. Do you remember those? You were probably a little too. Let's get some eyes on the IOU and then the Benetton, and I promise people we're going to move on here. Or maybe we'll move on, and when Jacob gets these things going, we'll take a look at it. There was a lot of red today, or there is a lot of red today. We're about, an hour and a half into the market here. Some of the things that we've been chatting about over the last couple of weeks are interesting. Doug Cass sent me, and I don't have it, but Doug Cass sent me this. It was like a graphic. It was like a heat map of the S&P 500. And by the way, maybe you can help me out. There's 503 components in the S&P.
Yeah, I don't. Well, but at least one of them will always be listed as unclassified, so we're not sure what's happening.
What does that mean? Is it
I don't know. It doesn't fit into a
or
sector. There's some like data glitch, something like that.
That's fine. And basically saying over the last 1 month, the S&P is whenever this was calculated, probably 2 days ago or something like that, was up to 2.5%. Oh, look at that. That's from Doug Cass, just to be clear. He put that in the email. And so you see there's a lot of red. Maybe the blue and purple are unchanged. Green is up. But you get a sense for what's going on in an S&P that's up 2.5%, which is one of the reasons why, Liz, you over there at SoFi like to talk about the RSP. That's the equal weight S&P 500. Maybe we'll pull that up for a second, Amanda, if you would do that. And, it's telling a slightly different story. Carter has highlighted in his technical work over the last month or so the fact that the Russell, which did do it briefly, the Russell 2000, has not confirmed the new highs in the S&P and the NASDAQ. You look at the RSP there, you can see that's kind of the same thing. What are we doing over there? Amanda's telling us that her computer is very slow, and I've been suggesting it would be amazing if you would get a new computer. We do have an account at the Apple computer store, so please do that. So you have this equal weight RSP. You see a flat 200-day, which is really interesting. Let's speak to that a little bit, Liz. Speak to the non-confirmation of the highs in the market cap weight in a flat 200-day.
Yeah, well, I mean, obviously they're related. So when you're looking at smaller cap stocks and the equal weighted S&P, we're getting more of an influence from the smaller cap names in the equal weighted S&P. The reason we talk about small caps so much is because of exactly what I think it was Doug that said this. they should confirm or deny what's happening in a market cap weighted index, especially if that market cap weighted index is being affected by cyclicality in the economy or just risk appetite generally in the market. So the fact that the Russell 2000 made a new high last week, that's positive. Okay, let's be happy about that. But in reality, and I believe we talked about this last week on the show, in reality, it just finally got back to where it was in like 2021. So it's been almost 5 years, because if you go back before COVID, it's been almost 5 years of just nothingness in small cap stocks if you sat in that index the whole time. And the Russell 2000 is going to have a high correlation to the equal weighted index. So it feels like a lot of nothingness in that index too, where it just can't quite get ahead of it. There's been all of this talk about, okay, rate cuts are starting again. So this is the time for small caps to outperform. And I may be splitting hairs here, but using the word outperform drives me crazy right now at small caps, because it is not an outperformance. It is them catching up to what large caps have already done. When you're talking about small caps outperforming during a rate cut cycle, that's almost always after a recession, after there's been a bottom in the economy, a bottom in earnings. That's not where we are right now. So if this rate cutting cycle drives small caps higher and they come out of this chart pattern that we've been looking at, it's really just them getting to a place where they're catching up. And that would be more of a broadening out trade, not some sort of durable outperformance of small caps.
Right. But, the one thing I'd say about that is going back to that heat map that Doug showed, over the last month, that is speaking to the opposite of broadening out, right? It's speaking to an increasingly concentrated sort of trade here. And let's just pull up, sorry about that. Let's pull up the market cap weight for a second here, because, or the chart of that, because to me, let's look at a 1 year and then a 5 year. And I don't like the Russell here, to be honest. So Guy and I on Tuesday, we put a little bearish trade in the options market. We're looking at the November 245, 225 put spread. That was it was about a quarter of the width. It was about $5 or something like that. And so you look at this, let's put a 200 there you go. So that thing's flattened out a little bit. You saw that breakout level that we had from I want to say early June or so, or actually is early July. I mean, there's no reason that we couldn't see a 5% pullback, maybe back towards those late July lows, maybe that 200-day moving average, 180 or so. This is the RSP. Let's go to the, because Amanda's computer here. I may have to take over here. Let's go to the SPX or the SPY, whatever you want to do here. And so, I say to myself, this is something that it really feels like it's just been kind of notching. And so if we get back to that kind of, what is that, 6350 or something like that in the S&P 500, that was the breakout level. So I don't know, where are you, if we don't have the confirmation of equal weight, we don't have the confirmation of the Dow, we don't have the confirmation of the small cap, can the S&P, in your opinion, keep doing all the heavy lifting? Because we know what's in there, and we're going to break some of that out in a second.
So here's the thing. I could easily make a bear case right now. And you could sit there and make a bear case too. We could say small caps aren't telling us that the economy's in as good of shape as we thought. Labor market's weakening. That's obviously playing out in a small cap story in some ways. All of this, right? We could make this case. However, if this turns out to be just an adjustment cycle for the Fed, just trying to get closer to neutral, history tells us that large caps tend to outperform in that scenario. So we wouldn't necessarily need small caps to confirm it if that ends up being the case. The big question is, we don't know if that's going to end up being the case. Maybe this is the beginning. It's starting as an adjustment cycle and it turns into something where they have to save the labor market. Who knows? That's probably a 2026 question that we won't have an answer to until at least then. But if this turns out to be in a bull case scenario, the Fed just moving towards neutral, the economy is able to digest it, the markets are able to digest it, large caps do tend to do better in that scenario anyway, and concentration probably sticks around.
Yeah, and one thing that we all took away from Fed Chair Powell's comments, not yesterday or 2 days ago, but last week, when he mentioned growth, right? He suggested that kind of 1.5% expected GDP growth for this year, it might be a touch better, right? So we have GDP that comes in quarter over quarter, it's better. There's personal consumption was better. I mean, there's a whole host of things in there that spoke to, and so this is why yields are up. The 10-year yield is up. And this is why I suspect the stock market's down, because it really, the stronger the data that we get, is that the less likely we're going to get more rate cuts, right? And we can look at the CME Fed Watch tool, that sort of thing. So is that what's going on in the stock market today? That's just not down a whole heck of a lot. I mean, the Russell was down 1%, but the S&P is down like 0.5% right now. The NASDAQ is down about the same. Talk to me about like where you shake out with yields. If we, and Guy and I were talking about this yesterday, we were at 4.4, you know what I mean, a month ago. You see that 200-day moving average, which is flat. Maybe we get back there. So if we're back at 4.4 in the 10-year, where do you think the stock market is, especially if the data is like if the data is okay here, we see that PC and stuff like that. Is it a strong case for more rate cuts?
Yeah. So first of all, what's happening today, if you look at the intraday, especially on the 2-year yield, you see a spike in the yield around 9 a.m. between 8:30 and 9, but a lot of it happened at 9. That particular move, I believe, was in response to comments by Kansas City Fed President Jeffrey Schmid. Said something along the lines of rates are in the right place, policy is in the right place to bring inflation down. So adjusted some of those rate cut expectations. But to your point too, we did get another revision of GDP today, and personal consumption came in much higher than originally thought, which is something that is important to remember, because for a while, and this is actually something that Powell said in his last press conference after the meeting, was that GDP growth expectations had come down because consumption had slowed. So this is showing us that consumption is actually stronger than what we originally thought. We could have an entire debate about whether or not data revisions are the real problem here. but anyway, that's what I think is going on. As far as what's happening with yields, I know I've said this before, but we are in a place where, yes, yields are down on the year. Okay. I was at a dinner last night and I tried to ask, there was a person from the administration there. And I asked, aren't things working in a friction state right now, in the sense of yields aren't coming down as much as the administration would like them to, and some of the policies and the ballooning debt and so on and so forth are actually what's driving yields higher. So how are we doing both at the same time? How are they going to pursue their goals of bringing yields down while also keeping debt so high and continuing to spend, blah blah blah? And the retort was, well, what's the best performing bond market in the world this year? And the answer is the US. I didn't really have a response for that. That's true. So over the course of the year, they've come down, but I don't think they've come down as much as people would have expected, especially in a cutting cycle. So I still think that there is concern over long-term debt and what we're going to do about it. And then in the short term, the 2-year yield is so volatile just based on what might happen with the Fed and the data that comes in that might tell the Fed what to do. So I don't think that we're going to squeeze a lot out of the bond market here. In fact, I think this is probably a bad entry point for what's going on right now and what might happen with inflation for the rest of the year. But it is something that the administration, I think, is going to watch. And as we saw in April, the bond market is very powerful. As we saw in April, it is also something that can make administration change their mind on policy, walk things back, change basically the trajectory if the market isn't doing what we expected.
Yeah, no doubt. Let's pull up the CME Fed Watch tool here, because this is something that we keep a close eye on here. So here we are, 25 basis point cut October meeting, which is late October, the 29th, right? And we see it's about 83.5% of a 25 basis point cut, which is down from like 93%, right, a week ago. So do you think that like we get listeners, viewers ask us about this all the time, like how closely should we watch this sort of thing? And, a good example is in a day like today where you have strong data and you see the probability, you see yields move higher, right? You'll see this move lower, right, of a prior sort of expectation of a near certainty of a 25 basis point cut. I think we could all agree, even if we had, next month, we get in the next couple of weeks, we got a hot CPI, a hot PPI, that sort of thing. They're still going to cut 25 basis points. You know what I mean? Like in October, like what, so whatever. And then if there's any shocks, like this is the push and pull, if you think about it, that dual mandate, right? So if we continue to see weakening, labor market, it kind of is in contrast to what we're seeing as far as consumer spending, right? Like there's just a lot of cross currents here. So, the economy, the market direction, this all seems clear as mud. Let's get your note, because I think this is really important. Sometimes, we're looking at, or you guys are looking at stuff, getting a bit granular. I always
Mhm.
like this stuff because there's a lot of market participants who have not lived through a recession, have not lived through a protracted bear market, have not lived through, years of, rate cutting cycle for just normalizing things, getting to that neutral rate, right? There's always this other, or these other inputs that cause like a lot of pressure on the Fed. So here's your note: echoes of the past. Is there anything that we should be thinking about, echoes of the past, or is this just like a nice little thing that you came up with? There's
This
no
is
pun
just
here.
this part was Mari. I was like, what do I call this? Because
Yeah,
we had it written and I was struggling with the title of Liz Looks At. What are we looking at? So
yeah.
he came up with that. I came up with Step and Repeat, which is the title of the column. And Step and Repeat, for anybody who's not in broadcast, when you have like a background screen and
Yeah.
you've got logos, that's called a Step and Repeat.
I don't
Fun
even know that.
fact.
What? Explain that to me again.
When there's like tiny logos behind you that are
Oh, do you know that?
like, it's called a Step and Repeat pattern.
Step and repeat. Okay.
Anywho,
Anywho.
so here's what we did in this column, because we talk about the 90s so much. So I was like, all right, so what if it is the same? What if it's similar? We're in another tech super cycle and this is the next one, right? Maybe we can expect these to happen about every 25 years, something like that. So here we are in it. How far into it are we if this is going to resemble the 90s? So we started to do some overlays.
Mhm.
And this first chart, first of all, I expected this to look different. And we've seen different versions of this chart, but what we did here, and I made sure we're not cherry picking this data. We're not trying to fix it so that it works for us, right? We started both of these charts. This is both this current period for the AI era and the internet era in light blue. We started both of them in the year when the Fed started hiking rates. So we know that happened in 2022 during this period. It happened in 1994 during the internet era. So they both start there. The climb is pretty similar. And what's really eerie about this is both of them had a big drawdown in April about a few years later. Strange, maybe a strange coincidence. Regardless, even just looking at this very simple chart, we can see that if it is the same, we might only be about halfway through this. And that doesn't mean that it's not going to feel completely irrational all the way up. The internet era got completely irrational at the top and towards the top. But even if this is the case, we've still got a ways to go. So maybe some of the bulls that sound so unhinged won't look so crazy if we're only halfway through. Now, of course, there are things that we have to heed the warnings of. And when you look at these lines, particularly the internet era line, there are some pretty steep drawdowns in the midst of this upward moving bull market. And I'm willing to bet, now I was in high school for most of this, so you'd have to tell me how you felt. I don't know how it felt at the time, but I'm willing to bet that many of those drawdowns were a similar vibe that we hear today. The drawdown starts and everybody thinks this is the one. This is the thing that's going to last. This is what takes us down all the way. And there were all of those false starts of, well, it took us down a little bit. That turned out to be a really good buying opportunity. So if this is the trajectory we're on, there's still a decent amount of runway here. It's just that the names within the index itself probably change and the winners change as time goes on.
Yeah, I think your point about what happened between 94, and 2000, really the end of 1999, and the volatility, it wasn't, a lot of folks think this was just kind of a parabolic sort of move.
Right.
And if you just look at lower left, upper right, obviously it had an epic move. 1997, there was the Asian, currency debt crisis. And then in 1998, there was long-term capital. The great book by Roger Lowenstein. If you guys, if you're a market participants, you're interested in just some of the inner workings of the markets and just some really interesting trades and stuff that has the potential for systemic risk. Roger Lowenstein, When Genius Failed. That's short too. There's no pictures, I don't think, but it's short. And you can get through that in a day or two. But both years there was 10, 11, 12% peak to trough declines, and there were two things that were at work here, right? So there was the macro, and there was some of this just kind of financial engineering and the like, and then there was a secular trend where most momentum investors were all in on this, and then you had to play catch up if you were somebody who just didn't believe in the sort of internet, what that was going to do and how it was going to transform, the economy. There were people, just think about this. Jeff Bezos did not care about what folks were saying about his company, this little thing that was internet-y, and you could buy books on it. And it was like, who the hell buys books? I can just walk down to, Barnes and Nobles and buy a book. Why do I have to put my credit card in something that I don't really, all that sort of stuff? Heads down, building this thing. What the investor base was doing, what investors in general were doing with the stock, that's another story. And, we make this case all the time. It's like, okay, it's one thing if you're out there making these massive proclamations and you're saying this is going to be $1 trillion market opportunity, and you keep just doing that, it ends up being, $1 billion market opportunity in the near term, that sort of thing. But I don't think this is really what was going on with a lot of the real serious sort of people in there. And they were talking about a vision for the future that actually came to pass, but markets can have bubbles. You know what I mean? Like that's kind of the point. So that's what was going on there. There was this kind of push and pull. And then it became obvious to everybody in 98 and 99, there was clearly a bubble, but no one knew when it was going to end or how it was going to end. If you took the other side of it, you absolutely got destroyed. One thing that I think is very different though, Liz, is like, it is clear to the smartest people in tech, in finance, maybe even in government, that generative AI or AI applications that are built on top of it are going to change the economy, possibly the world. But who knows when the timing is going to be? And what's different is that the NASDAQ went up like 80% or something in 1999. That would nearly be impossible in this environment, right?
Sure.
That's all. So that's my quick 411 on that. But there's some things that are starting to pop up right now, and you keep hearing about this stuff as it relates to NVIDIA and OpenAI investments and the leasing of this. And we've been talking about this for a while. That's similar to what went on back then.
Yeah. So a couple things. There's a small paragraph in my note where I said hype was building and investors believed the world would never be the same. Markets were right. The world would change dramatically because of the internet. It just took longer than we expected, and stocks went through a rationalization phase before we understood the full story. So to your point, the market's right. AI will change the world, right? It will change the way that we do business. It will probably change over time every industry in some way. But the internet did that too. It might have taken 15 years for some of those industries to really see what was happening, and even for e-commerce to be a real thing that everybody was on board with. So there's a cycle that this has to go through. And when I look at then we'll talk about this a little bit later, but to your point about the NASDAQ being up 80% in, you said 99, the composition of the market was different back then. So the S&P before the internet era, tech stocks, the tech sector was only 6% of the S&P. And then a bunch.
Don't we have this?
We do. It's a chart later. But the point would be that because we started this era with tech stocks as such a larger proportion already, it may not be as dramatic. The market rise may not be as dramatic. The multiples may not get as dramatic. And that's what I think a warning that investors need to heed. Instead of looking at it as, oh, we need to get to that inflated level of valuations before this is going to pop, we might not be able to, because the composition of the market is different. We got to those levels then because we started at such a small amount, and then all these companies got added to the S&P as they were growing. There aren't companies getting added to the S&P because of AI right now, or at least not that many, not like that. So the weight in the S&P went from 6% before the internet to 35% at the peak in 2000. We're at about 35% today. Right. So if you add in the 4 Mag 7 stocks that are not a part of the tech industry, we're at almost 50%. So we're already well beyond that. But the growth in the market, the returns in the market may not end up being as dramatic because of that difference in composition.
Yeah. And this is something we've talked about this before. A lot of tech folks will talk about this. They're going to bring this up right now. The Perez, this is well talked about as far as technology and the way, we have this Perez hype cycle. This is a woman who,
I was going to have you bring that up. Yeah.
Yeah. So, you know what? That would be a great blog for you and Mario.
The hype cycle. I used it. We had a leadership meeting in San Francisco a couple weeks ago, and I did a fireside chat with Anthony, and when we used the chart of this.
Dude, we can't get a look. I mean, Anthony Noto, CEO of SoFi. I mean, at some point we should have Anthony. We should all do. I mean, Anthony's been on our podcast. He was on the Tape podcast, I want to say a few years ago. He has a fascinating personal story.
Yeah.
And we won't get into go find it in the On the Tape feed. I think it was a few years ago. But his story professionally, he was an internet analyst in the late 90s at Goldman Sachs. He was doing all the banking back then, or most of the internet banking. So he had a front row seat for all this. His access to these the investors, obviously, but also, the people that were building these companies. And then he became a banker, and then he worked, I think, at the NFL, and then he went to Twitter. And obviously he's been presiding over the IPO of SoFi, but then also the amazing growth that you've had. And he obviously, hired you, Liz, which is, probably.
I mean, he makes good choices.
The best. Yeah. Amazing. Let's just bring this up for a second. And I just Googled this, and this is one of, so it just let's focus, let's focus on the top there. Okay. If we look at it, so on the rise, you see what's going on. This is for a technology cycle. You see what happens at the peak, and you can go through all these sorts of things. What I want to focus in is sliding into the trough of disillusionment, right? So that's kind of most of that middle thing. You see the blue line coming on, and then you're going to get to different phases here. So the slope of enlightenment, I think, is important. And that's really the deployment phase of the technology. So what's clear is we're easily on the rise. Who knows when the peak is going to happen? There will be a trough of disillusionment. This is the one issue, Liz, and I'd love for you to help me think about this. I cannot find anybody who's in the ecosystem, whether you are a builder, whether you are an investor, whether you are one of the folks that are thinking about how this technology is going to benefit your own company as you start to invest in it, who are really speaking about when this trough of disillusionment might happen. Nobody can see the potential right now. And that is a scary place to be, which leads me to believe we're very near the peak.
Yeah, well, so I agree. I don't think we've hit the peak yet. We're on that first leg upward. If I had to guess what might cause us to get down to the trough of disillusionment. Now, to be fair, if we're talking about AI as a theme, that's what we're looking at here. At least that's the way I'm thinking about it. AI as a theme, and that this is the cycle of AI. The trough of disillusionment, I don't think, is going to be something like, oh, AI has no use case. AI was, all hocus pocus. That's not the disillusionment. It's the level of market enthusiasm that occurred. And what I can imagine is, as other companies and maybe even other countries figure out ways to compete in this space, whether that's through acquisition or through partnering or through, who knows what it is, right? Maybe it's circular funding. We can get into that a little bit. Right. But as other companies and other countries start to compete, that's generally good for consumers and maybe good for businesses that are looking at this as a use case, because it should bring prices down. It should make availability better. It should democratize the process. However, it would highlight perhaps some of the inflated valuations of certain companies, and maybe also highlight, okay, the original winners that we thought would be the winners forever in this space are actually losing to this new competitor, or whatever the case may be. So I think that could be part of it. There could also be, this is just a more simplified version.
We just want to throw this up there.
Yeah. There could also be China, right? China could end up being a bigger competitor than we expect them to be, or there could be some real trade barriers with China that bring down the revenue expectations of US tech companies. So there are a couple things that a lot of this hype, especially in stock prices, has depended on remaining true. If those things do not remain true, then I think you go over that peak and you go through this period of like, oh my gosh, it's over, or the stock valuations are over.
Well, I think it's more market related than actually
Correct.
As it relates to, and you mentioned a couple things that I think are really important. I mean, what's different now to 25 years ago or even longer as it relates to the internet is like all the innovation was happening here, right? It was like literally, it was Amazon, it was eBay, it was Yahoo, it was AOL, it was Netscape, it was Google eventually. You know what I mean? There was a whole host of things. Now, there was plenty of crap companies that were just kind of, on a wing and a prayer, sort of thing. But it really wasn't happening. There wasn't a lot of important innovation that was going on outside the place. So if you think about China, this push and pull, this trade war that we're in, it's coming at a very interesting time for a technology that is not only the sort of thing that's going to have to do with, the economy, it's also a really important technology for the defense apparatus and the intelligence apparatus. And then there's going to be, people keep talking about sovereign AI. The thing about sovereign AI, different countries building out this technology, they're going to actually just think of it as an example of what's going on with TikTok. You know what I mean? This is a sovereign sort of situation where Oracle, okay, and we know that there's defense contractors in every industry in every country. Oracle is going to have this data on their cloud. They're going to have the algorithm on their cloud. They're going to operate this sort of thing. Is that sovereign AI? You know what I mean? It's not like all of a sudden you're going to have this massive bid for build outs of data center from companies or countries. We don't have the energy. We don't have, there's a whole host of certain things. So I just think that's something that could be a bit, inflated. And then if you just think of like, okay, the use cases, they're going to come. But they're not going to, there's going to be a situation where they're not going to come fast enough. And then because of the investment cycle and because of the valuations, you will get to a period. And, crypto is not too different for all intent. Does that make sense? We've seen these cycles play out in Bitcoin and the related ecosystems.
Yeah, it's just that we've seen it play out in crypto over time now. And obviously crypto hasn't been around as long as the market has, but we've seen a few crypto winters. So I think people are a little bit more used to that. There hasn't been an AI winter yet. So if and when we go through that, I think it's going to be really tough for people to swallow. But there are indications right now that it'll come at some point. And the main point of my column is that it'll come at some point. And at some point in there, I said, I'm a big believer in the business cycle and a big opponent of this time is different mentality. It's never really that different. We still have to go through it. It just might take longer than we thought. And it might take longer than a lot of our classic signals are telling us it should. But it will happen, right? It's just a matter of, the technology sticks around. As an investor, you have to have the stomach strength to look at that part of the cycle when it happens and say, I'm either going to stay invested or I'm going to buy more, right? As it's happening. And we haven't been through that yet. I think it's going to be a really
more thing is really hard with the names in the public markets, because what we saw, when the S&P is going to sell off 10-15%, you're going to see Palantir is going to be down 30%, or you're going to see Nvidia down. That's the hard part. And sooner or later, there's going to be one sell-off where if you keep averaging down, you're going to be underwater in a big way from some of those earlier purchases. You just do you do Pilates? Because this is something for most investors, core strength. You just said the stomach strength. I think that's probably, is that an important thing to do? Is if you're investing, do the Pilates and then you're going to have the stomach strength.
That is an option. I do power yoga.
Okay.
Also very focused
on
the
do
core.
like goat yoga? Do you do goat yoga?
No, I don't do goat yoga. Which I don't really understand. It's like you put a tiny goat on your back or something.
I think my kids have done it. I just heard of somebody who did cat yoga, but I'm not gonna name any names. I'm not gonna name any names. All right, so we just discussed these cycles. We discussed concentration. We discussed the potential for a pullback. But some of the work again that you're doing in your note, let's kind of go to the internet era. What you're tracking is the idea of cutting cycles, hiking cycles, and how that affects basically the markets. This is an interesting one.
Right. So remember the first chart where we overlaid the S&P now versus then. This is just then. So this is only the internet era. Light blue line is the S&P 500. Magenta line is the Fed funds rate. So a similar pattern to what we're going through now. It just happened at different time frames. So you see the natural hiking cycle there in the beginning. That's where those charts start. And then you see right around that 1995 period, the Fed begins to cut, but they're doing it in a careful, measured way. This is an adjustment cut era. This is them just trying to get closer to neutral, try to find that right balance where the economy isn't too hot, not too cold. the market continued rising all the way through those little adjustment cuts. And then there was a very long pause. There was one tiny little hike in there, a very long pause from 96 all the way through 98, mid 98 or so, a few more cuts, right? But the market continued to rise. As we can see, there are some intermittent drawdowns, but continued to rise. And then in 99, because the economy started to get much stronger again, there was concern over wage inflation. The Fed started to hike. Now, the reason we wanted to show this is because current obsession with the Fed is a lot of political force, but also just obsession of the Fed is able to change the trajectory of the market with what they're doing with rate cuts or hikes. And what I think everybody had expected is if they have to hike, if they cut too far and they have to hike, it's going to be kryptonite for the market. Well, if they do it carefully and they have to hike because the economy got really strong again, if you look at history, the market can actually still do pretty well through those hikes. It's once the hikes, go ahead.
Little bit of a news flash.
Sure.
There will not be a rate hike for the next 3.5 years. I'm just gonna that is not happening. Like,
yeah, I don't think it is
under any circumstance. I can just not see that happening.
Yeah, I don't think it will either. So this little pause, that's why this time will be a little bit different, likely. This little pause with a tiny hike in there, I don't think that's going to happen this time. It might just be we may have already been through the pause.
You were saying that. I'm just saying, like, yeah, that
I think we've already finished the pause, right? So now we're on the second cuts down.
We had David Zervos of Jefferies on Fast Money last night, and David is generally, and I like David. I think he's a really smart guy. I think he'd really like to be the Fed chair. He is one of 11 people that they're interviewing. He has fully acknowledged that, and his messaging, as you would expect, is like the Fed's missed it. They're too politicized. That, like, he had four other things, and they should be cutting rates dramatically right now. The problem with that is that if you're in that camp, you almost have to acknowledge that the economy or the labor market is weakening. I mean, so it's really hard, because if this is, like, they say the Fed's too political, but the reasons for which any one of these next Fed chairs are going to get the job is because of political reasons. You know what I mean? So there's a level of hypocrisy there. And it runs the risk of really creating an asset bubble, which is really what happened, at that kind of stage where we see the stair step. Well, listen, it is what it is. We know why ultimately they had to cut rates down to, what is that, just under 2%, the Fed fund, because the bubble burst. Okay. Right. Let's do this really quickly, because I know we got to hit a bunch of things before you got to get out of here. So the last one, the contributions to the S&P 500, I think this is something that a lot of folks who weren't around in the mid to late 90s, this might become as a bit of a surprise. Was it a surprise to you when you were doing this work?
Absolutely. Like a surprise so much that I asked Mario to double check his work.
Yeah.
I said, I don't think that first one is right. Can you do it again? But it was right. So what we're showing here is all of the S&P X Infotech. This is just the contribution to return. This isn't the actual percent return. So the proportion of the return that's attributed to these companies. So everything that's not in tech attributed more than 75% of the return during the internet era. And tech stocks, or the tech sector itself, only contributed about 24% of the return, which is crazy. But if you remember what I said earlier about when that era began, tech stocks were only 6% of the index.
Right.
So a lot of it was a composition difference. Financials were a really big part. Healthcare was a big part. And healthcare actually was a big driver of returns during that period, because there was a lot of biotech innovation that was going on, a bunch of wonder drugs that were coming out. So, which also a little parallel to this, right? We've got GLP-1s that have happened.
Genentech, by the way, they were mapping the human genome. This was a huge story in the late 90s. Do you know that? And the ticker for Genentech was DNA.
Oh, cute.
You see what you see what they did there? Not me. You see what they did there? Yeah. No, but that's a great point to bring up. I just wanted to kind of throw that in there.
Yeah. So this definitely surprised me. I think this surprises a lot of people, that it wasn't actually tech that drove a majority of the proportion of returns in the S&P during that time. Fast forward to today, it's much more evenly balanced, tech versus the rest of the index. Now, part of this, we know that there are stocks that fall into communications, that into consumer discretionary. So there's a little bit of convolution here, but You could look at this and say this market is a lot more concentrated, which it is. It's a lot more concentrated. We're depending on a lot fewer names to carry more weight. But you could also look at this and say, well, maybe there's an opportunity in that blue bar of this era, if the economy stays strong, for some other sectors to come in and shine, to step into the limelight, which is what I said in the note. And my money would be on healthcare for that as well.
All right. I just, again, I think it's really important to note that a lot of folks who call it the internet bubble, the contribution to the returns for the better part of the late 90s had a lot to do with stocks outside of tech. And that just highlights how tech just ate our economy over the last, 25 years or so. So the bars on the right don't surprise me a lot. Let's hit a couple things, Liz. And I just think that by the way, I can't get out of your little segment here without saying this. If you want this,
I thought we were going to miss it today.
if you want this
I thought you
blog
forgot.
in your email box, go to SoFi.com/on-the-money, and you can sign up. You have it in your email box. I'm sure that's also where you can find Liz's the important part. That's going to be her podcast that comes out very soon, I believe. I've had a little preview of some of the guests that you're going to have, and it's great. So the first season or second season, both of them are on there too. Probably go to your favorite podcast store, find it, follow it, rate it, review it, share it. That's how people find it. So go to SoFi.com/on-the-money. There you go, Liz. Great
you.
work there. Thanks, Mara. So we were just talking about some of the site. I just want to pull up Bitcoin for a second here, because this is a 5-year chart. There's a 1 year really quickly. It's kind of breaking that uptrend from the early April lows. Let's go to the 5-year. You see where that 200-day moving average is about 102,000. And this is one relative to, let's say, gold. We've been highlighting this a bit, especially with the dollar weakness, that gold just has broken out and kept on going. And you look at here's Bitcoin. So right there, that's the chart on the 5-year. It just started to break that. So just keep an eye on that one. The volatility there has been great. I'm sure if you're trading it, fantastic. But I also wanted to highlight MicroStrategy, Liz. I think these treasury securities, these companies that have been selling their equity, their debt, anything that they can't or is not bolted down, and they're buying the underlying. In this case, it's been Bitcoin. So, we've seen volatility in this thing earlier this year. It got down as low as 250. I just kind of highlight that range, that support range to the downside. You tell me. I'm not asking you to tell me, but, might we see a move back towards $250? That would be telling to me about this strategy that strategy has, that they basically have a lot of fast follows in it. And I just think if you take leverage out of this sort of trade, that there could be some reverberations here, Liz.
Yeah, I mean, anytime you see a chart like this, you could insert a lot of different tickers into a chart that's going to look similar to this. There's a gap there that I don't see having gotten, well, it got filled already, but then we went back up. The enthusiasm and the spikes up in some of these names, whether it's based on, tokenizing or crypto or whatever the case may be, when sentiment shifts, these are the people that get affected the most, because they bought in due to sentiment. They will sell out due to sentiment. So it's not people that are sitting around doing a bunch of fundamental research and buying for the long term. So this is similar to a chart that Mario and I have used over and over and over again that shows the proportion of returns attributable to earnings growth and then the proportion attributable to multiple expansion. This is a stock that would fall into that multiple expansion piece, at least that big spike up, and some of what we're seeing now, giving back the multiple expansion and the sentiment or the vibes of everybody chasing each other into it.
Yeah, but it really, and this is one of the things that's a great example of just an irrational sort of move. The stock was trading, I think, at 3 times the value of its Bitcoin that it holds. And it's just interesting to me that now it can't get out of its own way. And, Bitcoin is down, maybe, I don't know, 15-16% from those recent highs, maybe a little less. And this thing has basically, it's not cut in half, but it likely will at some point.
Yeah.
So taking that leverage out of the system. Let's go to a more a less volatile name. This would be Costco. Reports after the close, 3.5% implied move. We've been talking about consumer confidence, or at least spending, which has really kind of bucked a lot of the expectations, especially when you look at a labor market that is slowing. This one, Liz, a series of lower highs. It's just broken that uptrend that's been in place since late 2023. That's just a technical thing. We know the stock is always well expensive to the retail group, to the market, that sort of thing. What do you think a 13%, like move off of those recent highs, which when I say recent, earlier this year in February, and the market is at all-time highs, is it telling you anything about the retail space, about a consumer that maybe is not being reflected in some of the data that we've seen?
Well, I think it is reflected in some of the data. You just have to dig deeper. So consumers, because of inflation and because of so many years of inflation, and because inflation hasn't come down, we still forget that point sometimes. They've had to make choices, and they've had to shift maybe from goods to services or services to goods. And it's gone back and forth quite a few times. And some of these names, Costco is one of them, Walmart is another, had done really well through that inflationary phase because they were lower cost providers to consumers, and it was helpful. And I think that their stock prices responded, and rightfully so. They were rewarded for that. And if there was good inventory management, even better, right? They were trading on some of those fundamentals because there were competitors that were not doing such a good job with that. And it was a really tough time for retailers to keep track of consumer tastes and consumer spending appetites because of inflation. But perhaps it got a little ahead of itself, not just Costco, some of the other retail names too, perhaps got a little ahead of themselves in thinking that a consumer would continue to spend at those clips into perpetuity. Well, they're not. And now we've got a year where the data is showing that the consumer has had to pull back their spending or make choices because of how much some of the necessary goods do cost now. So I think some of that is just being reflected here, and just the exuberance coming out of the consumer trade, because the data and GDP, aside from the revision today, the data and GDP had showed us that consumer spending had slowed down quite a bit.
Yeah. Okay. Just wanted to hit that one. To me, I'd just be really surprised if this company is be able to give the sort of guide that are going to get folks excited and take the stock back up towards 1,000. And then you really got to watch kind of a continued breakout. Maybe if this stock is trading in the near future near its April lows, I think that that's something. If you are focused on retail, if you're focused on consumer spending, I think you're really going to have to pay attention and figure out how to extrapolate that to other parts of the economy and the market. I want to
hold on, just one more quick point on this too. Some of that run up in Costco and in Walmart, and some of the other, like TJ Maxx, right? Name a low cost provider that did inventory well throughout this period. A lot of their success was because they were taking consumers from other retailers,
right?
Other retailers who weren't cutting prices as much, or who weren't managing their inventory, or whatever the case may be. They were basically eating the lunch of some of the other retailers that didn't do it as well. So they got the benefit of that. Well, that shift is probably over. That shift has occurred. And now consumers are not moving around and trying to find new places to spend money. They're just kind of staying where they are.
Yeah. Again, and we've been talking about this trade down a little bit. Agreed. Last one I want to hit. You were just talking the circular nature of this AI spend, or at least the investment from NVIDIA and all these companies that are going to buy their chips. And we've been talking about this, and I'm not trying to, just say we're kind of early on it. Well, we were early on it because there's some of this stuff. Well, so I said we're not trying to do Let's go back 3 years. Okay. So Microsoft has the foresight to look at what's going on at OpenAI. At the time, OpenAI was a nonprofit, right? And so it was founded by some of the biggest geniuses in Silicon Valley. And they basically, and it's probably the CEO of the company, Satya Nadella, who built this cloud infrastructure over the last 10, 12 years or something like that. And he finally found the driver of, let's say, growth of this infrastructure that he built. It's this thing called generative AI. And his belief was that they're going to basically be able to have a bunch of companies, at least that were on their platform, increase usage of that platform or find new customers to use this technology. They invest $13 billion in OpenAI. OpenAI thus will actually rent more of their compute, right? They have right of first refusal on it. OpenAI is buying GPUs, all right? And Microsoft's obviously buying GPUs for their Azure cloud. So companies like OpenAI can train their models, right? And so then you see NVIDIA just absolutely take off. Everybody knows that. They have the GPUs that go into the servers, that go into the data centers, right? And so that's been a monster for NVIDIA. And now we have a situation where NVIDIA is investing everywhere that they can. They invested in CoreWeave, which is a neo cloud, which is a company that basically creates these data centers that a company like Microsoft will use when they need excess capacity. They sign long-term deals. So NVIDIA is an investor there. NVIDIA is now an investor in Intel. NVIDIA is an investor in OpenAI. This is the big one. So people keep talking about it, and I could go on and on and on. So all these companies are basically paying each other ultimately to buy their services. And at some point, it won't take much of a crack to get ourselves in a situation where, like we're going to have a big slowdown, because if everybody is just kind of buying each other's crap, if there's not demand or increased demand and there's pricing, weakness in this sort of situation, you're going to have a difficult time. There's not a company that kind of envisions or like encapsulates all the risks here as much as Oracle. Oracle's cloud was like, as far as market share, was low single digits when we started this year. Now they've gotten all of these contracts. OpenAI is a big one. They are so tied to OpenAI, far more than, let's say, a Microsoft is. And they're going to have to spend in a way that they have never spent before to basically realize their ability to, to kind of, serve these contracts that they've got. They guided that big gap, is they obviously guided to a number over the last 5 years of revenue based on these contracts they've got. But this is a company that is going to have to spend a great deal more. They're raising debt. That was the story yesterday. I just think these guys are going to be the one holding the bag, because they don't have the infrastructure already built the way Google, Microsoft, and Amazon have. So I just think that gap, you got to watch your ass here, people, because if that thing starts to fill in, that is going to be, in my opinion, a precursor of this path towards the trough of disillusionment. How's that, Liz?
That was great. No, that was great. And I had promised our audience that we would talk about circular funding later, and there you just did it. And it happened in the 90s too, right? There were circular funding examples in the 90s, and it's not necessarily leverage in the traditional sense, but all those companies end up levered to each other. And when one part of the circle starts to crack, and you've got a company sending money to the next one that feeds its revenue stream, that's sending money to the next one that feeds its revenue stream, then you've got a lot of revenue streams that suddenly deteriorate. So the ratios and the fundamental analysis for those people who are actually doing it, that would fall apart too. So it is another indication. It's another sort of, tally on the board of, this is something to watch. And I say this to you guys a lot. I often try to think to myself, okay, in 6 months' time, in 1 year time, what will I look back on and say, we should have paid more attention to that, or that was the thing, right? This could be one of the earlier warning signs, and maybe things did change. Maybe things did change with that deal.
Yeah. All right. Well, we're going to keep an eye on all of this. We're probably going to talk about it until we're blue in the face and you're sick of it. But hopefully we'll provide some other insights and opportunities and ideas. So Liz, really appreciate you being here. That's Liz Thomas. She and Mario, write that great note. You know where to go to find it. Go to SoFi.com/on-the-money. Thanks so much, Liz. We'll see you on the Risk Reversal podcast next week. How about that?
You bet. Go Packers.
Much. Go Packers.